How exactly does a trader with, say, just $500 in their account end up controlling a massive $50,000 market position?
I mean, honestly, it sounds like a typo in the bank software, right?
Right.
But it's actually just the foundational mechanic of the foreign exchange market.
Right. And welcome to today's deep dive, by the way. We are getting right into the underlying mechanics of Forex trading today, specifically looking at how retail traders mathematically magnify their capital.
Yeah, and also how they end up delegating these really complex trading decisions to professionals.
Exactly. Because when you're throwing around that kind of weight, the stakes are, well, they're incredibly high.
Oh, definitely.
So to understand the math of magnifying capital like this, we really have to look at the engine first, which is leverage and margin. Let's take a standard 1 to 100 leverage ratio.
Okay, so with that specific ratio, every single dollar of your capital controls $100 of market exposure,
Right, so if you want to open a $100,000 position on the euro to US dollar pair, you only need a 1% margin.
which is just $1,000.
Right. And I think it's always helpful to remind ourselves that margin isn't some kind of fee you're paying. It's really just a security deposit to hold that massive position,
Yeah,
like a portion of your balance just set aside.
exactly. It's collateral. And the crucial part of that mechanism, the real why it matters here, is that leverage amplifies your personal exposure, not the market's volatility.
Meaning the market is just doing its normal, everyday thing. The euro isn't suddenly swinging wildly just because you personally decided to use leverage.
Right, exactly. If the market moves 1%, it's still just a 1% move. But with a $100,000 position, a 1% move is a $1,000 swing.
Wow. So if you only have $1,000 in your account to begin with?
Yeah, that tiny 1% market ripple
Okay.
either instantly doubles your money or it completely wipes you out.
It just obliterates that security deposit.
Yeah. The broker will actually step in and trigger a stop out, which is just a forced liquidation to prevent your account from going negative.
So because a single 1% swing can wipe you out, you essentially have to have a flawless behavioral track record.
Which is nearly impossible for most people.
Right. And that intense pressure is exactly why so many retail traders decide to just hand the keys over to professionals.
Yeah, but how they actually do that changes everything about their risk profile.
Yeah.
You basically have two main paths you can take here.
Okay, PAMM or copy trading. Right.
Right, so with a PAMM structure, which stands for Percentage Allocation Management Module, your funds are basically pooled with others under a master manager.
Got it. So it's totally passive.
Exactly.
Okay.
It's manager-centric. You aren't watching those individual trades hit your personal account in real time.
Okay, and copy trading.
Copy trading automatically mirrors a provider's trades directly into your personal account. So it gives you complete visual transparency as the trades are actually happening.
But wait, if copy trading gives you that visual transparency and lets you, pause trades or adjust your sizing in real time, doesn't that extra control inherently make it the safer option? I mean, you literally have the steering wheel.
Well, see, having the steering wheel is exactly the problem for most retail traders.
Really? Why?
Because that extra control is usually a trap. I mean, beginners just lack discipline. The psychology of watching your personal account balance fluctuate in real time is brutal.
Right, I can imagine.
A professional trader expects normal drawdowns. They know a strategy might dip, say, 10% before bouncing back.
But an everyday trader watching that happen?
They emotionally interfere.
Mm-hmm.
They'll panic and manually close a trade at a loss right before it recovers. Or they'll get overly confident after a winning streak and mistakenly increase their position sizing right before a huge loss.
Oh, man. So they basically tinker with the engine while the car is flying down the highway.
That is a perfect way to put it, yes. And that's where PM comes in. It limits that behavioral risk by delegating execution entirely.
Because you literally can't panic click the sell button.
Right, because you don't even have the button.
Yeah.
You're forced to act more like an investor.
Mm-hmm.
You're evaluating the manager's overall performance and their fee structure over time.
Instead of being this emotional micromanager reacting to every single tick of the chart.
Exactly.
So it really all comes down to self-awareness. Whether you choose a PAM structure or copy trading, your decision has to match how you actually behave during market noise, not just how you hope to behave when you're feeling calm and analytical.
So true. But there is a bit of a dark side to chasing those managers too.
Oh, what do you mean?
Well, the sources warned that a strategy's high returns often just hide incredibly aggressive leverage behind the scenes.
Which really leaves you with something to ponder here at the end of our deep dive. When you're out there evaluating a star trader to follow, are you actually investing in a genius strategy? Or are you just blindly riding someone else's lucky, over-leveraged gamble right up to the edge of an inevitable margin call?